This episode of Macro Mondays was aired live at 12:30 p.m. BST on Monday, the 30th of September. Tune in Mondays at 12:30 p.m. UK time to watch Macro Mondays live.
Hello and welcome to another Macro Monday. My name's James Brodie and I'm Head of Learning and Development here at Onyx Capital Group.
And I'm James Todd on the direct trading team here at Onyx, hoping to give you insight from Onyx's trading floor.
Today we'll be discussing the market impact to last week's huge Chinese bazooka stimulus. We'll look at the mixed US data and discuss the payrolls coming ahead this week, and also look at last week's particularly weak CPI coming out of Europe.
We'll be looking at the continued momentum behind the S&P and gold as they continue to make new all-time highs. We'll be looking at some of the geopolitical ongoings in the Middle East as Israel have recently made attacks in Lebanon and targeting Hezbollah. And we will be, as always, looking at key market charts, trends, data, and risk positioning.
So let's start with a huge stimulus coming out of China. This is unprecedented. We've seen stimulus new headlines coming out most days from the last week. Even this morning, again, we've had some more stimulus. So it started last Monday. The central bank cut the 14-day repo rate 10 basis points to 1.85%. Then on Tuesday, we had a whole load more headlines. They cut the bank's reserve requirement ratio by 50 basis points. They're cutting rates on existing mortgages. They cut the 7-day repo 20 basis points, and they cut the minimum deposit for second homes to 15% from 25%. They also mentioned that they will allow securities firms, funds, and insurers to tap PBOC funds to buy stocks. That, in my view, is unprecedented as well. Then on Wednesday, they cut the 1-year refinancing rate from 2% to 2% from 2.3%. On Thursday, China, they considered 142 billion capital injection to major banks. And then today, headlines come out, they've cut the mortgage rates for the first time and second time homes by around 50 basis points. We've seen huge reaction from the market, and this is going into Golden Week. So China's on holiday from tomorrow, the 1st to the 7th. And also China, tomorrow is the 75th anniversary of the foundation of the PRC, People's Republic of China.
Yeah, I'm not overall surprised that we've seen aggressive policy making here. We've been hearing rhetoric coming from some of the senior members of the Chinese governance that had been indicating that they're going to be doing quite a lot in order to try and restabilize and support housing prices. It looked otherwise as though, things were going to get rather desperate in terms of the Chinese real estate sector. So we've seen a whole week now going into a second week of aggressive policy making and policy changes in order to make mortgages more affordable. But this has also not only had an impact upon mortgages, it's also, as we're going to see, had a huge impact upon Chinese stocks.
Yes, if we look here, the Chinese CSI 300 equity index, that's up now 25.2% in a week. That would be a good return, extremely good return for a year, but this is just 1 week. And I don't think I've ever seen a chart like that. No,
it's, if you're on a roller coaster, this is the bit that you're sort of relaxing into before the big drop. But it's really quite dramatic, isn't it?
Yeah, this is what you'd maybe expect to see from a commodity where there's very little volume, but this is a main equity index in China. We've also seen China's property stock gauge up 11%. We've seen iron ore up this morning just 10.7% in 1 day alone. The CSI index that we're looking at here, that was up 10%, limit up this morning, so that closed for trading. Also, Shanghai Futures Exchange most active freight index, the Europe route, hit limit up 20% this morning as well. So seeing huge returns. But the question is this a new economic dawn, or is this actually just a reaction, a panic mode from the government?
Yeah, absolutely. Stocks going higher, fantastic. That is, in general, we all know, a sign of a better economy. This sort of a dramatic movement, I wouldn't read as being a sign that the Chinese economy is going to be doing well or has been doing particularly well. This is a dramatic change on monetary policy, interest rates going down, the advantage, the upside of saving money decreases. People will look to put money in commodities, one would have thought, or also stock indices. So I think that will be one of the larger explanations for why Chinese stocks have rallied so much. And if we try and look at the underlying strength of the Chinese economy, I think it's very worthwhile looking at gasoline prices and diesel prices in the Far East. So we haven't seen a dramatic upside on price action in gasoline. So if we look at Singapore 92 cracks, for the average person out there, that sounds like gobbledygook, I understand, but measures the strength of gasoline in the Far East Asia, Singapore being the major benchmark, but this can be seen as quite a decent proxy for Chinese gasoline demand. We haven't seen much strength at all. In fact, prices since last week have been coming off in Asian gasoline. So you would have thought if an economy was doing well and derived demand for the average middle class consumer was increasing, then prices would increase. This hasn't happened at all, and we've been seeing relatively weak prices in gasoline, and similarly in diesel we're sort of almost net flat on where we were right at the start of the month. Both products have seen a decent amount of volatility, but this certainly hasn't been a strong month for either product.
That is a really good point. The stock market going up doesn't necessarily mean the economy is doing well. And what this does actually, it gives the Chinese investors something to invest in, because property has been going down now for 2 years, and we know they've been moving into gold. And what you can see here is a chart of copper, which you can see that's been trending higher as well, but actually that's having a weak day today. It had an aggressive rally this morning on headlines, and now as we came into the recording room, that's trading on the lows of the day. But some insights from some of the world's leading investors. David Tepper, famous investor from Appaloosa Management, he said he's buying everything China. But the flip side, Macquarie Securities' Larry Hu said policy has moved to emergency mode, and with respect to property, they're trying to stop the decline. He also said the longer term picture though still looks the same, grim. Structural forces will keep considerable downward pressure on growth. Also, Lombard Odier's Chief Investment Officer Michael Strobeck said he's sticking with his decision to sell all Chinese stocks and bond holdings. He says he doesn't think the stimulus will have a lasting, sustainable impact on either the stock market or the economy. So, as you said, we've seen an aggressive move in the last week, but it will be interesting to see how the market digests this over the next few weeks, and if we see any data coming out of the economy.
Yeah, absolutely. I mean, it's a clear, the positive signs are the government is intervening. They're not just going to let this go to let the sort of housing market in China crash and let everything go in free fall. So that will provide some support to speculators and investors. But yeah, I don't think this changes anything in the underlying state of the Chinese economy at all. So I think we'll see that on the supply side, as well as the demand side, things aren't looking too rosy.
Yeah, although it's secondary to the stimulus, we did have some data out of China last week. Chinese industrial profits fall sharply. And you can see that here from the chart. You can see here it's a leading indicator. Also, Chinese manufacturing PMIs came out this morning, actually better than forecast, but at 49.8, manufacturing is still in contraction. Moving on, September 2024 is now the biggest month of monetary easing since April 2020. More central banks have been cutting rates this week. Switzerland cut for the third time this year, 25 basis points down to 1%. Sweden's cut for the third time, again 25 points down to 3.25%. And the Czech Republic, seventh meeting in a row, cut a quarter down to 4.25%. What I find most interesting out of these three is here, Switzerland, they've cut rates down to 1%, but the overnight index swap shows the market expecting rates down to 0.33 in the next 12 months. So the market's starting to look at the possibility that actually we're going back to negative rates. And if just looking at the chart here of global central bank policy, you can see the rate cuts. It's only been higher basically during COVID and the financial crisis. So it looks as if there's some form of panic setting in with central banks.
Absolutely. And, when we look at Switzerland cutting rates, if they were to cut rates further, and even at 1%, what you're seeing is negative real interest rates as inflation outperforms the interest rate. So savings in real purchasing power decrease over time. I like this a lot because so often we talk about the dollar. From a British perspective, we talk about the pound and the Eurozone as well. But these are signs that what we're seeing is not a problem unique to the Eurozone. It's going, this policy is being enacted by non-Euro currencies throughout Europe. Everyone is really experiencing the same issues. And it's one of those things we saw in the financial crisis. The Swiss were one of the first to really, hammer interest rate cuts. They're being very proactive again, and I would expect to see a continued lowering of interest rates, not only in these non-Euro currencies within Europe, but across a lot of the developed world. I think you were mentioning HSBC was forecasting.
Absolutely, I did mention that with the euro. Yeah, we will come to the euro in a second, inflation, but HSBC now expecting the ECB to have to cut rates at every meeting through till April of next year. On to US data. Mixed data in the US last week. US pending home sales are up 0.6% month on month. That was actually short of estimates of 1%. But actually a decline year on year of 4.3%. Also, mortgage applications are skyrocketing, up nearly 60% year on year. Actually, new home sales fell 4.7%. So what we're seeing here is increasing refinancing. Not necessarily a good sign. On the one hand, yes, people will have more money in their pockets, but on the other hand, household savings have been depleted. So,
yeah. I mean, this obviously off the back as well, we might expect to see it continue with the 50 basis point, the 50 bip cut by the Fed last week. Perhaps if we're seeing an increase in refinancing, that might signal that your average prospective house buyer isn't necessarily anticipating a huge number of cuts over the next calendar year or so. Or perhaps they're just happy to finally lock in some lower rates and not have to continually bleed. But yeah, it's clearly a sign that things have been very tough for the average consumer in the US over the past, 24 months, I'd say.
And we can see that as well from the data. US retail companies' bankruptcies are spiking. So here, retail bankruptcies have reached 26 year to date, almost matching the number for the entire 2023. Also the third highest level since 2011. And if we look at the Richmond Fed regional survey, this has fallen below the pandemic level. Employment actually is below the lowest level since the financial crisis. Employment in the manufacturing sector is absolutely awful. We're seeing that from all indices. US consumer confidence has fallen as well, the biggest 1 month decline since August 2021. The present situation index has really taken a nosedive there. So again, more concerning signals coming out of the US. And we have really the biggest piece of data this week. Friday, we have payrolls.
Yeah. It will be interesting to see. Obviously, everything we're sort of discussing here is very retrospective, and it's slightly hard to forecast what's going to be, what the changes are going to be over the next 12 months or so in an economy of more aggressive monetary policy. But yeah, it's just, everything seems to be carrying on in the same way, and none of this data looks particularly positive.
Absolutely. And with the election headlines coming out over the weekend, Harris extends lead over Trump from a poll from Reuters and Ipsos. And another headline, Kamala Harris is offering $25,000 down payments to all first-time buyers. Personally, I mean, this is more government spending. I don't see where they get it from. But also what that does, it typically then puts house prices higher. Just means people have more money to bid up. If anything, it puts a bid under house price, makes them even harder to attain.
Yeah, I mean, There was an interesting headline in the FT last week discussing how the headline basically said when there is uncertainty over who is going to be the next president, stocks tend to underperform, and then once there is certainty, they continue to perform. What I think the real data underlying that was suggesting was that when Democrats are in contention or going to be elected, generally the S&P doesn't like it as much. And if you look into the article, you can see that when Republicans are clear favourites, you see the S&P performing well. So I do wonder whether, we're going to come on to talk about the S&P a bit, but if we were to see Harris coming in and more policy and more spending in order to prop up the housing market in the US, I do wonder whether we could see a significant downturn in the S&P on the back of that.
And that would probably fuel more buying for gold.
Absolutely.
Before we move on to that, European inflation dives below target. French CPI last week came in at 1.2% year on year, expected to be 1.6%. Spanish inflation significantly below 2% as well. We've had the regional inflation out of Germany this morning. That looks like it's going to come in harmonised at 1.7%. This is all below the ECB's 2% target. So again, I think the ECB should be cutting more aggressive than expected. We've mentioned HSBC are calling that as well. But if we go back to where inflation peaked, in France, it was 6.3% CPI, Germany 10.5% in October 2022, and Spain 10.9% in July 22. There are some economists talking about the possibility we start to sniff deflation again next year, particularly if the oil price does break below the key 70 level.
Absolutely. I mean, if commodities, if oil and also if power continue to become more comparatively affordable, then you may well see, all of these inflation metrics, painting a picture of a potential deflation or certainly lowering inflation. So whilst I think you have to couple your view on interest rates with your view on power a bit. So if you're bearish power prices and the cost to the average consumer of powering their home and similarly gasoline prices for their commutes, then I think interest rate cuts ought to be enacted for sure. Also with Germany, employment signals more Eurozone weakness. Here you can see the German manufacturing PMIs here, highly correlated with Eurozone competitive employment PMIs. Again, just more weakness ahead there. 20 basis points price for next ECB meeting. I'd see that's 25, and the market may even start to look at the possibility of 50 if we get more weaker data. Also, Germany's September IFO Business Confidence Index fell again to 85.4, estimated to come in at 86. Actually, just a headline that came out less than an hour ago, Germany's set to abandon forecasts for economic growth this year, which kind of thinks an admission of defeat. Absolutely, that's very worrying.
Moving on to Australia, key economic data in Australia, they've been the last to start pricing cuts. But inflation dropped sharply last week from 3.5% to 2.7%. Again, a massive move, far bigger than expected, partly driven by government electricity rebates. But again, this is the one central bank that really hiked the least. The market's been reluctant to price cuts, but now it's going to start pricing cuts far more aggressively.
Absolutely. I quite like this for, that line of analysis saying the electricity rebates clearly having an impact on inflation. And this is something that, as an economist, your duty is not just to look at the headline, but to look at the underlying. So, I quite like that one.
And onto equities. So the S&P continues to break higher. We have an internal chat we update on economics and markets movements each day. S&P, we've been talking about new all-time highs, gold, new all-time highs. Interesting point here today, though, with the S&P. It's now trading at 22 times forward PE. That's double what it is trading in 1985, more than double what it's trading in 84, 87 and 98, and actually higher on a forward PEs than 2000 and 2007. So it's historically expensive, but it's trending higher. What do you do in such a scenario?
Yeah, it's difficult. You can't necessarily just keep expressing this negative opinion. When things go up, people get stopped out, and even if you're not necessarily getting stopped out, having sticking your finger in the air and getting a sense for the momentum of the S&P, you can see that things have been strong. And this is why I do find it quite interesting going into the election period, and this is something we can look at in more detail in weeks to come as we draw closer to the US election. But if we were to see the Democrats get into power, and if we were to see more policy to make housing affordable, you might see some outflows from retail investment into the S&P. So there could be a bit of a bubble here, but who am I to say that it's time to get short?
Exactly. You can have all the fundamental views in the world, but the price is trending higher, it's trending higher.
Absolutely.
And what do trend following traders do? What do the automated algorithms? They're mainly trend following. What do? They follow the trend and it's going up. And
if we continue to see rate cuts by the Fed, there may well just be more buyers than sellers. So
yeah, the market's still pricing a soft landing, so the economic data's holding in. Key level, support level, 5,670. That was the previous peak. But while it's above there, investors are happy to keep buying. The Nikkei, on the other hand, is down 4.8% today. So we had a leadership race off. The LDP party in Japan, the ruling party, surprisingly won by Shigeru Ishiba. He'd previously criticized aggressive easing policy. He's going to be the new prime minister. He's more hawkish. So this news actually came out on Friday. We saw a more aggressive buying of the yen. We saw the overnight index swap starting to price a more aggressive central bank. And today we've seen that filter through to the Nikkei, off 4.8%, while other equity markets are moving much higher. So central bank OIS pricing for the next 12 months. The market's still looking for another 183 basis points of cuts by the Fed. The ECB is discussing maybe actually that's behind the curve because the market isn't pricing 25 for each of the next meetings. I think they should be. Other standout one for me here, New Zealand. The market's pricing over 2% of cuts for the next year.
Yeah, we have said for a while that New Zealand sounds as though they're going to be quite active in cutting, and off the back of what you've just been saying about the Japanese fall today, seeing rate increases there. It's interesting to my mind that over the next 12 months, it's just a 25 bip increase. It's very much a mixed bag because they've reached historic highs over the past month or so in their stock market, but all is not well in the Japanese economy compared to it by the standard metrics that we use to measure economies.
For sure. And pushing on to gold. Gold hits more all-time highs. Chart here to highlight gold's global imports. India's global imports rose to $10.6 billion in August, new all-time highs, equivalent of 131 tons of gold. Keep buying gold.
Yeah.
Here, central banks buying, Chinese retail buying, although we'll see that dwindle as they move into equities. Global fiscal concerns. Personally, I think this gold, it's trending. It has a lot further to go.
Yeah, it's reached its all-time highs. It's exceeded them. We're sort of the past 3-4 weeks, we've continued to see strength. Central banks like it. It's a nice trade from a recession perspective. I don't see the issue with gold sort of continuing to perform. Hard to know when one should take profit or look to get out of this, but it's just been doing so well.
And an interesting chart to support that is silver. So India's imports record amounts of silver as well. You can see here clearly the previous peak is at 32.51. It broke above that briefly on Thursday last week. That's a new 10-year high, but certainly a close above that would be a good buying opportunity. I say it's a 10-year high. It's not an all-time high like we've seen with gold, because I'll bring up the next chart. This shows you just how high commodities and how quickly commodities can run. This shows the move in silver back in 2011. And what you got there was a really crowded trade. Funds went all in max long. And what they weren't aware of was the fine print in the exchange contracts. When volatility goes over a certain level, then margin requirements go up. And that happened. Margin requirements suddenly went up. And the only option they had then was to sell existing positions, reduce their positions. And the market fell abruptly 33% in 2 weeks. So this kind of highlights just how quickly and aggressively commodities can go, but the risks of being all in.
Yeah, and it's just an interesting point in general in terms of analysing anything trading related. Volatility has such an impact upon markets and the ability of participants to hold risk. And so when you see, as silver clearly had in this situation, when you see a spike in volatility in either direction, that can lead to managed money and stepping out of the game and people having to either immediately stop out or immediately take profit on any holdings they've had. So that can really have a distorted impact upon the prices of commodities and anything sort of stocks related.
It's a really important point as well, focusing on market positioning. So something I didn't mention earlier, the CSI 300 index, it's up over 25% in a week. But what we had at the beginning of last week was the market was the second shortest position ever in China in the iShares China Large Cap ETF. So the market had its second shortest position ever. It's rallied over 25%. That's absolutely crippling. So market positioning is also key to watch, as well as just the
price action.
The price action.
Definitely.
On to Brent. Brent's back just above our sort of 70.5 key level we've been discussing for weeks. Key things, we've had Israel, Hezbollah strikes. Another key thing I found very interesting, the market's been record short Brent and diesel, but as we were saying earlier, the market's been long bullish gasoline.
Yeah, and in terms of price action, we're still not seeing gasoline performing, and diesel, as I mentioned earlier in the show, is sort of on parity with, well, prompt diesel is on parity with where it was at the start of the month. But it's difficult to convey necessarily why what's happening in the Levant area is significant to oil markets. But as a brief attempt at an explanation, I think it's worth paying particular importance to what's been happening in Israel and in Lebanon and in disputed Palestine. Because whilst we see, neither Israel nor Lebanon necessarily has huge resources in terms of natural oil fields, many of the allies that are involved on either side do. And so Hezbollah, they are Iranian-backed, Iranian-supported, and have allies in, if we were to look at the Houthi military group in Yemen, they would, I'm sure, be expected to make some form of action in response, in retaliation to what Israel have done over the past week or so. Now, the Houthis had been previously targeting freight ships headed for Israel. If you were to see an increase in attacks from Houthi militants on freight rates, that makes freight more expensive, so it's more expensive to transport oil, whether it be crude, whether it be products, from region to region. Insurance premiums are more expensive, etc. It's not hard to understand why it becomes more expensive. And then obviously, as Iran has huge numbers of oil fields and oil resources available to it, if they were to be involved, you might see. It's difficult to know exactly what's going to happen because there are so many sanctions in place with Iran already. But yeah, they have a lot of resources behind them. They can move things in a lot of ways. They would be unlikely to be able to flood a market due to sanctions, etc. And what you might see though is an increase in retaliation from countries that are more aligned with Israel upon, Iranian outlets of crude. I think at the moment, China is probably the most significant market for Iranian crude oil to go out to, and yet Iranian crude only makes up about 2% of the Chinese crude oil consumption. So this indicates that the impact of Iranian oil on the market will perhaps be less than the market's impact upon the Iranian economy.
Yeah, what I find interesting is the price action today with all the news that's coming out of China and the news over the weekend, Israel strikes on Hezbollah. The oil price, as we came into the recording studio, is on the lows of the day. The Brent price. And to be clear as well, Brent and diesel record shorts there in the market. The gasoline is with our own proprietary data. The open interest is the highest it's ever been. And the market is long that. But that's more they're long the spread against Brent because that's come in so much over the last few weeks.
Yeah, I think worth clarifying that's the Eastern gasoline as well, the Singapore 92 run. Yeah, there is a huge amount of open interest. And I think one of the reasons for this is people, not only do you have your regular players, but you have people using Singapore Eastern gasoline as a proxy for Eastern macroeconomic development.
Interesting. On to Bitcoin. We touched on this last week. Where do we think this goes next? Well, the short-term trend's high, but if we look today, it's a very negative candle on trading on the lows of the day, but the short-term trend is up. But longer term, it looks like sideways congestion. What are your thoughts here?
Yeah, I'm slightly curious as to exactly why it's down on the day. And I do wonder whether perhaps we're seeing a converse relationship between the Chinese stocks indices and Bitcoin prices. I find that relatively unlikely because I think, if we look to the S&P and US stocks, things tend to be slightly better coupled. But it would be feasible for people to not, a lot of people in China or in Asia might look to invest in stocks domestically rather than as Bitcoin has been performing relatively well over the past sort of 5 years or so. You might see less retail investment in Bitcoin and more in retail stocks.
Yeah, with a sideways chart like that, I think retail investors in crypto would be struggling.
Yeah.
There's no trend there for the moment. On to the US 2s 10s yield curve. We mentioned that last week, chart of the week. It has broken slightly higher, trading around 18. You can see a clear trend. Again, I think with central banks cutting rates at the front of the curve aggressively, we'll start to see the back end of the curve start to steepen as investors talk about potential inflation maybe next year. But certainly that's trending one way. This week's chart of the week shows euro yen here. No trade entry level for now, but a trade entry to go short if it closes below 155. Two sides to this story. One, very negative, the euro here, and also secondly, more bullish, the yen with a new, more aggressive prime minister. But again, I wouldn't enter a trade now, but if it breaks below that, closes below that key 155 level, then I think you'd get a much more protracted downtrend. Certainly extension of the data we're seeing out of Europe as well. So what do we have in the week ahead? Today, we've had some of the German CPI data, again, coming in very weak. Later today, we have the Chicago Purchasing Managers Index and Fed President Jeremy Powell speaking. Tuesday, we have ISM, US ISM manufacturing PMIs, and it's jobs week, so we have the JOLTS data, job openings. On Wednesday, we have ADP payrolls. Thursday, ISM services PMI. We also have jobless claims, but I tend not to look at this now. I think this has been somewhat distorted, firstly by immigrants who are losing jobs, don't have a job history. So they find it increasingly difficult to get insurance. And secondly, with a gig economy, a lot of people losing jobs are not registering as unemployed because they're looking to move on to very quick part-time jobs. So that would seem to be a less reliable indicator. Of course, Friday, we have the big one, US weekly, monthly even, payrolls. So a pretty busy week ahead as the market digests what's going on with China, even though actually it's going to be a Chinese holiday. And the market will focus on Friday's payrolls. I think we're going to have quite a lot of volatility.
Absolutely.
Thanks very much for joining us, and we look forward to seeing you next week. Have a great week.
Thank you.
Thank you.